Hey everybody, it's Boris. Welcome to the weekly technicals in the majors today for July 4th or July 8th. We're going to have a little bit of a holiday shortened week, especially in the US, of course, because Monday is going to be a day off for us. But the week really is going to accelerate into some very, very serious flow, especially because we have a ton of US data starting pretty much Wednesday. We start with the ADPs, then we have the ISM non-manufacturing, which is the basically PMI services for the US, and we culminate on Friday with the non-farm payrolls. And really, in many ways, it's a very asymmetrical structure as far as economics go for the euro dollar, for dollar yen, for the US data in general. Basically, what I mean by this is that we had a horrible number last month. Even if we have a good number this month, and it's very likely we might have a little bit of a realignment, sort of a reversion to the mean. Number is predicted to be about 190,000. If we do anything around 190,000, 180,000, the market will breathe a sigh of relief. But it really won't change the underlying monetary posture of the Fed at all. The only way that we could possibly have a revisionist view is if, under some incredibly bullish scenario, the non-farm payrolls print 250,000, maybe 300,000 new jobs, which is very unlikely because the pace of economic growth has been relatively steady and stagnant. There's nothing in the economy that shows a huge jump in demand for labor. So even if the numbers are relatively good, it's not going to change the fact that the Fed is going to stay stationary all the way till the end of the year. If the numbers are bad, that actually puts a much more negative onus on the U.S. economic data set. It suggests that the bears may be coming to their conclusion, or at least the bears may be completely correct in their view that we're actually maybe tipping into the abyss of the recession, that we could be at a precursor type of position of a recession, because this would be the second month in a row where you have this significant slowdown in labor. So very asymmetrical setup this week as far as the data set goes. Even if it's good, I don't think it's going to have much of a positive impact on the dollar, but if it's bad, it could really hurt the dollar quite significantly. And that's why it's definitely going to be worth watching very, very carefully. Other data this week, not much really coming out of the Eurozone. It's all second-tier data. In UK, we have a whole bunch of economic data, but of course UK is completely overshadowed by Brexit. I mean, but we do have the PMI services report, which is an important report simply because that's the largest sector of the UK economy, and the PMI manufacturing actually pre-Brexit was quite good. So it'll be interesting to see if the UK economy was vibrant going into Brexit. Of course, the situation has completely changed now, and I continue to believe that economically this is going to be a very, very difficult time for UK, simply because external actors, not just simply UK corporations, but all foreign investors. And we're already talking to several Americans, for example, who have businesses in UK, and they have essentially frozen any type of an investment outlook, and are frankly looking for alternatives to position themselves against the prospect of being shut out of the EU. Last week I tweeted out in jest, but only partially in jest, that I think the single greatest investment is Dublin real estate, and it may very well be the alternative route that a lot of European and American companies will take in order to make sure that they have a toehold in EU. But all of that really, I think, ultimately weighs very, very heavily on the UK economy, and the fallout from that for the next 3 to 6 months is certainly going to be felt. I mean, anything is possible with revision, and certainly things could really surprise to the upside. But for now, given the fact that we have complete calamity in both the Tory party and the Labour Party, and it's fascinating to see that Labour, which is the opposition party, is actually in some ways in bigger turmoil, with huge rebellion against Jeremy Corbyn over there. At the same time, of course, the slowdown in the political process that is going to take place simply because the election needs to happen, and that's not going to happen until September in terms of the election of the new Tory Prime Minister. There is really nothing going to be going on vis-a-vis the movement forward as far as exiting out of the Eurozone, because until and unless they invoke Article 50, nothing. UK basically stays part of the Eurozone. And so I think in many ways, I still think that the realistic prospect of Brexit is not going to happen, and that ultimately this may actually prove to be a long-term buy for the pound and UK assets, as true change is probably going to be swept under the rug. Now, I thought that Brexit wasn't going to happen as a vote, so I could very well be wrong. But it appears to me that the parties who actually were calling for the leave vote by no means really wanted the leave vote. And I'm talking about the politicians, not the voters. And I think there's just a tremendous amount of consensus amongst the UK governing elite to do anything in their power to essentially sweep this under the rug and negotiate some sort of a face-saving gesture that will allow UK to remain within the EU. But in the meantime, all of this puts just a freezing pall on UK assets, UK investment, and UK growth, and I think that makes cable still a very, very relative weak bet for the time being. The only thing that would completely change that scenario is if the market begins to sense much faster than even the general population and the political press that Brexit is not going to happen. And then you'll see a pretty viciously strong short covering rally in cable. But for now, it seems like every rally is going to be a sell. So let's just take a look at the basic support and resistance lines as the week shapes up, because it's finally going to be a less volatile week. We've tightened up our ranges, which I think are more realistic as this week comes in. The average true range is going to compress now that we've had most of the political shock pass us by. In the euro, the resistance now lies at the 113. What's very interesting about the euro, and I think this was a key tell, we'll take a look at the charts, is that there was a lot of support that came in at the 110 level. Now, we tested the 109 post-Brexit. Obviously, we broke all those heavy levels. But what was interesting is that we had some dovish comments out of Draghi that started to push the euro midweek all the way down towards the 110 level. And all of a sudden, boom, a lot of buyers came in right in front of that level. And it appears to me that unless we see significantly weaker news out of the eurozone, if we see some sort of a new monetary expansion accommodation program, which is unlikely to happen, it appears dubious that even under the best of U.S. data sets that we could break the 110. The 110 seems to be a pretty strong support. We'll take a look at the charts on that. On the other hand, dollar yen, the resistance really still lies at the 103, and certainly 105 zone. That seems almost insurmountable right now, unless you have a super duper hugely positive non-farm payrolls report. The reason why dollar yen seems so weak is U.S. yields. One of the untold stories, or sort of one of the more ignored stories, is just how low U.S. yields are. We were as low as 140 on the 10-year this week, which is just a massive, massive decline from 175, which was considered to be low a couple of weeks ago, which was even a huge decline from the near 2% we were just a couple of months ago. So one of the things that you need to appreciate about the currency market is the dollar yen is very, very sensitive to U.S. yields. And as the lower U.S. yields go, basically the bond market, one of the interesting things is that the bond market is really pricing a recession much more than any other market. And given the fact that the fixed income markets are usually the smartest markets of all the capital markets, you need to pay attention to that pretty carefully. Dollar yen just does not look like it's a buy, even both technically and fundamentally. Of course, surprises could happen this week, but support comes in at 100. Resistance 103, and it looks like it's kind of curling over. And cable definitely found a lot of selling offers at the 35s this week. Now, support still is around the 130, 132. The 131 was sort of the post-Brexit low. We get further negative news, it's quite possible that they're going to run for the 130. Certainly, at this point, the bears definitely have control of the game, and they have their eyes on the prize at the 130 level. For now, the 135 is a big, big resist. If we break that to the upside and can hold it, this is a critical thing. If we close above the 135, that's going to trigger a massive amount of short covering, and you could see 137 very quickly. I would quickly change my posture if 135 goes on a closing basis. But for now, every rally in cable appears to be a sell. Let's just take a look at the charts here and see where we stand. So here's the euro, and you can see what I'm talking about with the 110 being a very, very big buy. You see we dipped all the way down here, didn't quite make it down to the 110s, and the buyers just came in and swooped it right back up. We took it through the 11s, and 1150 now is the big resist. You see the level here right around. This is let me just lay down the line here. This is basically the 1150 resist line, and it's really, if you sort of were handicapping the euro, it's 1150, 1250. That's the zone of resistance here in the euro. That's going to be a much more chunkier zone for buyers to want to overcome. But the euro does not look bad. It's this kind of a V-shaped formation, a series of higher lows, really suggests that for now, at least, unless this 110 level is broken, it's a buy to dip story, much more so than it is a sell to rally story. With the yen, it's quite the opposite. Yen is just really rolling over. The 103s, 104s is a big resist. 100 still very much a very, very potential area for the shorts to eye. Now, of course, this is one thing that I think is incredibly important for anybody who's trading in Asia, especially. At sub 100, the BOJ and just generally the Japanese policymakers are going to be incredibly, incredibly furious at seeing the exchange rate below the 100, and they're going to try and do, I think, whether it works or not, some sort of interventionist, whether it's going to be verbal intervention or physical intervention. And I think it's very dangerous to want to try to short this through the 100s. But to the 100s, the shorts really could work, given the fact that dollar yen is really rolling over. The bet here is that the U.S. data is not going to be as sunny as the bulls believe. A positive U.S. data just simply floats us around, possibly pushes us to 104s max to the upside. But if you bet the fact that if you have an inkling that the second month in a row of subpar labor performance is just about to hit us on the NFPs, we look like very much going to curl over, and at least to the 101s, but definitely towards the 100s, as the yen looks to be a much more of a sell to rally type of story. And a similar story, by the way, with cable here. Cable, on a relative basis, just looks horrible. See, cable ended pretty much at the lows of the week here. We got rejected very, very strongly at the 135s. What's interesting about the 135s from a technical point of view is, remember, a couple of weeks ago, we talked about when we were preparing ourselves for Brexit, we were saying that 135 was the absolute multi-year support level. And of course, Brexit crashed that. And now, in a classic technical sense, what was former support now becomes a current resistance. And that's really what we're playing now. So until and unless a 35 gets taken out on a closing basis, you basically have to assume that cable is a short anytime it rallies up. The break to the downside here is going to be also quite interesting, because I think if it can break the 32s, it's very likely they're going to try to gun towards the 130s as the key target of the shorts. 130 is just a very tempting number, because there's probably going to be a lot of stops at that level, and they want to see if they can push it all the way down. So that's how the week shapes up. Euro looks to be relatively strong. This, by the way, we will discuss that in our crosses section, but the euro strength pound weakness presents us with some interesting opportunities as well on the crosses side. Yen looks like it's kind of dying out, and cable still a sell in the post-Brexit world. Wish you guys the best of luck, the best of trading. Boris, over and out.